go. So during the last couple of years, it's really no surprise why we might be striving for more balance. And that's the phrase of the day here is it's LPL, which is my research department, their research department looking to find balance in today's market and economy. We know that last year we had a great deal of imbalances that have been built in the economy, and we started to address them. And we believe that 2023 will be about setting ourselves up for what comes next as the economy and markets find their way back to steadier ground, although we're going to still have some adjustment period here. And I have to admit that, I hear a number of investment firms or analysts say, oh, this is the year, this is the year, this is the year. But, I have to be upfront and honest with you and tell you there are still a lot of challenges out there, and we're going to cover some of them today. So you feel a little bit like the old Charlie Brown, cartoon with Lucy always pulling the ball away. You think you're going to get a good kick. Maybe I shouldn't talk about that because some teams have lost games with missing field goals lately, but Lucy was always holding out optimism that Charlie was going to kick the ball, or at least Charlie had the optimism that he was going to kick the ball this one time. So the global economy will likely slow from the upper 2% range last year down to the mid 1% range in 2023. And, you just scratch your head that it says here in my kind of notes that a lot of this depends on China's growth path. And, companies are so tightly interwoven these days, politically, economically, from a currency perspective. It's just hard to, I know I feel sometimes like countries, including our own at times, try to take an isolationist view, but it's darn near impossible because we import, trillions of dollars of product from China in the consumer sector, and they purchase trillions of dollars of grain and commodities and technology from us. So, it's just darn near impossible to act in isolation as kind of viewpoint anymore, because it just can't happen. There's too much there. So an important aspect for investors is the U.S. appears to have fewer headwinds to growth. Now, this is saying compared with Europe and other developed countries. So again, not saying it's good, it's just not as bad. The divergence between the domestic and international economies is most obvious in the inflation arena. And we're seeing that Germany, for example, is still experiencing accelerating rates of inflation, whereas the US has likely moved past the peak. And we have learned from history that the longer inflation is unconstrained, the riskier of our growth prospects, because it becomes kind of interwoven into our economy. So one reason we're currently seeing a healthy debate on the likelihood of a recession is that for most of 2022, not all the metrics were flashing warning signs. Well, I'm of the opinion, and I think this this presentation is kind of putting their toe in the water, saying that, well, the same thing is happening here. That while we have this debate, we are seeing, if they're not red flashing lights, they're at least yellow flashing lights. If there's any optimism that we can derive from this, is the fact that the inflation itself is kind of petering out or balancing out. Whereas, like I said, here in other countries, in the developed countries in Europe, it's still accelerating. So on the plus side, our inflation seems to be decelerating, or at least balancing out a tiny bit, which is good. Now, the Federal Reserve has repeatedly warned investors about the potential for pain from the fight with inflation, and it's most likely associated with an unexpected increase in unemployment as the job market cools from a slowing economy. So the job openings and labor turnover report was hardly of great interest until Fed Chair Jerome Powell used a press conference to highlight the number of job openings in the economy. So what I see a lot of these guys doing, dancing around the edge here, guys and girls, is that if we're not close to a recession, we may actually already be in one. So I think we just have to get over that, just hope for a softer landing, but recognize that there is just a tremendous amount of uncertainty in the world today, like I mentioned, and it's going to take a bit of time before things, temper a bit. Now, housing plays a very significant role in consumer spending, and investors should monitor the housing market as a bellwether for the health of the consumer. Now, consumers today spend roughly 1/3 of their total spending on housing alone, and this decline in housing-related costs should give consumers more discretionary spending, which is good. So again, what you're going to see over these next few slides is they'll talk about something bad, like a potential recession, and then they'll talk about something good, like consumer spending. Then they'll talk about something bad, that China is still dealing with COVID, and then they'll talk about something good, how other countries are becoming, much more open. So it's that divergence of situations and factors that just, the old phrase goes that the markets just hate uncertainty. The market loves predictability. So if stocks are going to go higher in 2023, here we go, a prompt end to the Fed's rate hiking campaign will likely be a key component. And the timing of the last rate hike of this cycle is uncertain and won't even be clear for a little while, but our view is that the Fed will pause sometime towards the end of the first quarter or beginning of the second quarter this year, which is only a few months away. And we're basing this on an improved inflation outlook and a loosening of the job market. So should that occur, stocks would likely move higher, consistent with history. Stocks have tended to produce solid gains after hiking cycles end, including a 10% average gain 1 year later. So, historically, if we're having a mini recession, or if we're having this interest rate hiking campaign, once it ends, historically, we've seen 10% rates of return on typical the overall stock market itself. So the timing of the last rate hike of this cycle is uncertain and won't be clear for a while, but should, excuse me, gotta click one more button here, I'm sorry. Through many economic downturns, recessions, and geopolitical crises over many decades, the stock market has always recovered. Well, what I would put in there in parentheses is, while it was recovering, a lot of us lost sleep. So, we still got to keep our guard up here, that we're plan. They say plan for the best, or plan for the worst and hope for the best. So those patient and courageous investors who are able to take advantage of those declines have usually been rewarded quite nicely. Following down years, the S&P 500 itself has risen an average of 15%, with positive returns in 15 out of 18 years. So our base case for an S&P 500 earnings per share in 2023 is $220, similar to where 2022 is tracking, and about $12 or 5% below the consensus estimate as of November 2022. So what does that mean? They're saying earnings per share. So that's earnings of the company divided by the number of shares outstanding. So that earnings is essentially what revenue and profit the company is experiencing. The higher a PE ratio, you may have heard that phrase, frothier the stock market is. So if the stock market's got a PE of 12, then we don't have as much speculation. If it's 22 like it was, or 23, then there's a lot of speculation going on, and the price of stocks are getting pushed upward, perhaps even more than they really should in many cases. So our strategic and tactical asset allocation committee sees fair value for the S&P 500 at 4,400 to 4,500 at the year end 2023, based on a price to earnings ratio of 18 and 19 and $240 per share in the S&P 500 earnings in 2024. So again, we're, if you look at, you hear in the newspaper, oh, the Dow Jones Industrial Average was up 12 points. Well, what does that mean? It's essentially a small grouping of predominantly large company stocks. I think there's 30 of them in the Dow Jones Industrial Average. So it's just kind of like a thermometer. We also have the like the mid-sized companies are in their own index, like the Russell 1000, the Russell 500, and we've got even like micro companies that are in different exchanges. So I guess the point being is that what I see here is I see a strong evidence of optimism here that we're going to start seeing PE ratios of 18 and 19 as opposed to 12 and 13. So the path of interest rates will likely be largely influenced by the Fed's behavior, which will be guided by economic growth and inflation data. So equally important is the level of non-US developed government bond yields, as foreign investors are an important buyer of US treasuries. Higher foreign market yields, all else equal, generally dissuade foreign investment into our markets. There are a range of scenarios we think that could play out over the next year. However, given our view that the US economy could eke out slightly positive economic growth next year, we think 10-year treasury yields could end the year around 3.5%. Why does anybody care about the treasury yields? Well, if you're looking for, hypothetically, the most secure, non-loss of principal investment that you can find, it would be a treasury bill or treasury bond, because they are issued and backed by the full faith and credit of the United States government. Well, I don't know how good that is anymore, but nonetheless, it's definitely much less riskier with regards to principal when it comes to like corporate bonds, as an example, or bonds, mortgage-backed securities. And it's also important for, retirees who try to buy safer investments. And if they can only, like historically for the last several years, they've only been getting 1% rates of return on their money. And if they had a financial plan developed, which most advisors infused a forecast of 3 to 4% inflation, and like I said, 3 to 5% yields on bonds, and now they're only getting 1. Well, that financial plan all of a sudden is a bit irrelevant. So there are a range of scenarios we think could play out over the next year. However, given our view that the US economy could eke out slightly positive economic growth next year, there's some expectations for various fixed income markets under different interest rate scenarios. So if interest rates don't change at all, the best expectation for performance over the next year would be the index's starting yields. What does that mean? It's saying that whatever we started out at the beginning of this year is about the best that they can expect by the end of the year. So we're not seeing a whole lot of appreciation in the fixed income market. No, they're trying to be, again, positive here again, saying that because companies were able to refinance existing debt over the last few years and push out maturities, meaning longer maturities, so that they don't have to be redeemed and repurchased anytime soon. Only about 1% of existing debt needs to be refinanced this year, and less than 10% needs to be refinanced before 2025. So the need for companies to refinance existing debt at these higher levels seems to be currently muted. So I mentioned uncertainty surrounding the course of the Ukraine-Russia conflict has thwarted any diplomatic attempts to reach a negotiated settlement. The intense military campaign involves a significant contribution from NATO towards the Ukrainian war effort, especially that from the United States. Now, depending on how long the fighting continues, it's expected that many of the NATO countries, including the US, may start to debate the financial cost of the burden. Now, I'm sorry, I don't remember the name of the Ukrainian prime minister, but there was a lot of front page news thrown around when he showed up in his sweatshirt, and Biden talked about how he was authorizing another $1 billion in aid and arms sales, and the prime minister says, "That's great. We need another $2 trillion," or whatever the number was. So that Ukrainian war is starting to turn into a huge sinkhole, kind of showing some similarity to Russia's invasion of Afghanistan years and years and years ago. Ever since World War II, nobody ever wins a war, it seems. It just stalemates, and then they negotiate and say they're sorry and pretend it never happened. Now, the commodity super cycle spurred by China's hyper growth rate in the beginning of this century has waned significantly as China's leadership has focused on containing COVID-19 at all costs. The once strong economy has completely stagnated, and the boom in real estate projects have slowed dramatically, and now developers are mired in debt. I thought this was a kind of an interesting commentary because, I have to admit, for the last several months, I look at the news, I look at the internet, I watch YouTube, for a couple of news shows, but I've hardly heard of a comment at all about COVID, really, until just maybe a night or three ago. I was watching the news and I saw these film clips of I'm showing my age there, film clips of from China, where places are locked down like Europe was in the US over the last several years. Streets are bare, store shelves are bare, people are all wrapped up in masks and hoods and all sorts of stuff. And it's just incredible that the coverage of that news item is just falling right off the face of the earth. Now, everyone was expecting some huge, either profound or cataclysmic event to occur in the midterms elections, and it turned out just about as, if you ask me, I would expect, because it ended up in darn near another stalemate. I mean, we're pretty much politically divided 49 to 49%, so that every year the remaining 2% does everything from elect the president to select the House and Congress. So no big surprise to me that happened. So the Republicans gained enough seats just to win a narrow majority in the House, and the Democrats held on to their slim majority in the Senate. And despite Republicans' narrow House majority, their victory on the House, now this is interesting, I didn't think of this, significantly shifts the balance of power, since only legislation with broad bipartisan support will get passed once the new Congress is sworn, well, now that the Congress is sworn in. So I hadn't thought about that. I realized they were close, and I understood that, but I guess I hadn't resigned myself to a situation of stalemate, which could very well be the case going forward. So the most, I like the comment here is perhaps the most important outcome of the election is simply that it's over with. I couldn't agree more. Historically, midterm years have been volatile for markets, and 2022 has been no exception. So this will be interesting to see what history does, because this is the third year of the presidential cycle, and it has always historically been the strongest. And a weak 2022 may help set up that pattern again. So we'd like to add a note of caution, though, that increased fiscal stimulus in anticipation of the presidential election has often supported returns in the third year of the cycle, and we're unlikely to see that added tailwind next year. So we've seen in the past where stimulus programs at the end of the year trying to influence the voter population, we've just borrowed, if you will, and printed so much money. Right now, there's none left to do so. Now, this chart is kind of interesting, though, because it does show that a Democratic president with a Republican or split Congress has been a strong combination for stocks. So you can see if a Democratic president is 14.5, average Republican 14.8, and an average of the two of 14.7. So not that much of a difference. On the other hand, the other major takeaway from the election is that we now have this mixed government, again, with Democrats holding the Oval Office and a majority of the Senate, while Republicans have a majority of the House. And markets have tended to favor mixed government since neither party is able to get in its worst excesses, and any legislation that does get passed is subject to compromise. It may also be that the government that governs best is sometimes the one that governs the least, and mixed government has a tendency to create gridlock. So what do we get out of all of this? I think from my perspective, it tells me, which I feel every day, is we still have a ton of uncertainty going on, from China to Ukraine to Russia, here in the U.S. with the reemergence of supposed reemergence of Antifa rioting in Atlanta. I mean, what's going on in California. I also read where California now is proposing a new tax for anybody who lived in California and made money and then moved to a different state that's cheaper. So let's say they left California and went to Texas. Well, California is trying to figure out a way to tax some of their earnings, because I guess you're not supposed to leave California. So, if it were me, I'd really look at, introspectively how risky of an investor you are, because from my perspective, anytime we invest, we really only have three basic alternatives when it comes to protecting our principal. Number one is we can avoid any market fluctuation by staying out of the stock market and buying municipal bonds and government bonds and maybe a few corporate bonds. Number one. Number two is we can diversify that risk, and we do that, which most advisors will tell you to do, by having some small company stocks or mutual funds, some large company stock, having a very diversified portfolio. Or number three is you can offload that risk of principal loss to a third party, like an insurance company. And that's where we're seeing a huge emergence of investors purchasing annuities that are fixed or fixed index in particular, and maybe variable, because these annuities have the ability for you to make money on the upside, but in exchange, they provide you with a guarantee of no loss of principal. So what am I doing right now? Well, I have some clients that I never thought this would happen, but I've advised them that they need to keep their money at the moment in, like I said, the muni bonds, corporate bonds, government bonds, something I never thought we'd be doing, but it just makes sense because they've come to realize that they're not the aggressive investors they thought they were, number one. So I'm doing that. Number two is I'm further diversifying clients' portfolios by adding a component of what we call alternative investments. And these are investments that aren't necessarily part of the stock market and don't behave up and down like the stock market. And they include things like commodities, currencies, global real estate, managed futures, and other things like that. So I'm creating in client portfolios this increasingly get larger component made up of alternative investments. And last but not least is I've really embraced some of the new annuity offerings that have come out. Fixed annuities where no loss of principal for a designated period of time. Fixed index annuities where you can make money, but you can't lose any money. And even variable annuities that have what's called a living benefit rider or a guaranteed principal solutions rider that guarantees no loss of principal. So with that, I'll say thank you very much for joining me. Again, remember, if you want to catch a replay on this in a day or so, it'll be on my website at briantsikorski.com. Also on my website is, I wonder if I can get to it from here, but also on my website is a little link there where it says Outlook for the market for 2023, and you click on that and kind of read, if you want to call it a hard copy version. So again, thank you for joining me. I hope you all have a great rest of your day, and let me know if there's anything that I can do for you. Thanks.